Investing in mutual funds for beginners. Welcome to Be a Baby Billionaire. Mutual funds serve as versatile investment vehicles that enable individuals to collectively invest in a diversified portfolio of securities, including stocks, bonds, and other financial instruments. Managed by experienced portfolio managers, these funds pool the resources of numerous investors to create diversified portfolios aligned with specific investment objectives and strategies. By investing in mutual funds, individuals gain access to professional management expertise and a diverse range of investment opportunities that may be challenging to assemble individually. Diversification is a key advantage of mutual funds, allowing investors to spread risk across various assets, industries, and regions. This mitigates the impact of any single investment's performance on the overall portfolio and potentially optimizing long-term returns. 1. Introduction to mutual funds. Mutual funds serve as investment vehicles that bring together money from numerous investors, collectively pooling these funds to create a diversified portfolio of securities. These securities can encompass a variety of assets, including stocks, bonds, or other financial instruments. These pooled funds are then managed by experienced and skilled portfolio managers who are tasked with making investment decisions on behalf of the investors. Portfolio managers conduct extensive research, analyze market trends, and select a mix of securities that align with the fund's investment objectives and strategies. One of the primary advantages of mutual funds is the ability to achieve diversification. Diversification involves spreading investments across a wide range of assets, industries, or geographic regions to reduce risk. By investing in a mutual fund, individual investors gain exposure to a diverse array of securities without the need to individually select and manage each investment. 2. Mutual fund performance metrics. Mutual fund performance metrics are crucial tools used to evaluate the historical performance and risk-return profile of mutual funds. Some key performance metrics include annualized returns. Annualized returns represent the average rate of return earned on an investment over a specific period, typically expressed as a percentage. This metric helps investors assess the fund's historical performance and compare it to benchmarks or other funds. B. Standard deviation. Standard deviation measures the volatility or dispersion of returns around the average return of a fund. A higher standard deviation indicates greater volatility and higher risk, while a lower standard deviation suggests lower risk. C. Sharpe ratio. The Sharpe ratio measures the risk-adjusted return of a fund by comparing its returns to its volatility or risk. A higher Sharpe ratio indicates better risk-adjusted performance, as the fund has achieved higher returns relative to the level of risk taken. These performance metrics help investors gauge the historical performance and risk characteristics of mutual funds, enabling informed investment decisions. 3. Benefits of mutual fund investing. Investing in mutual funds presents numerous advantages compared to individual stock picking or other investment vehicles. One significant benefit is diversification, as mutual funds pool investors' money to invest in a broad range of securities. This diversification spreads risk across multiple assets, thereby reducing the impact of any single investment's performance on the overall portfolio. Additionally, mutual funds are overseen by experienced portfolio managers who conduct thorough research, analyze market trends, and make informed investment decisions on behalf of investors. This professional management expertise can potentially lead to better investment outcomes and help investors navigate the complexities of the financial markets. Another key advantage of mutual fund investing is accessibility. Mutual funds are available to investors with varying levels of capital, making them accessible to a wide range of individuals, including those with limited investment experience. Most mutual funds offer daily liquidity, allowing investors to buy or sell shares at the fund's current net asset value. 4. Types of mutual funds. Mutual funds are typically categorized based on the types of assets they invest in and their investment objectives. Some common types of mutual funds include equity funds, bond funds, money market funds, and balanced funds. Equity funds, also known as stock funds, primarily invest in stocks or equity securities. These funds aim to provide investors with exposure to the potential growth of the stock market. By investing in a diverse portfolio of stocks, equity funds offer the opportunity for capital appreciation over the long term. Bond funds, on the other hand, invest in a portfolio of fixed income securities such as government bonds, corporate bonds, or municipal bonds. These funds are designed to generate regular income for investors through interest payments. Bond funds may appeal to investors seeking stable income streams and lower levels of volatility. 5. Risk and return in mutual funds. Mutual funds offer investors the potential for returns in exchange for taking on various levels of risk. The relationship between risk and potential return is fundamental in investing. Generally, investments with higher potential returns tend to come with higher levels of risk. In the context of mutual funds, risk can be categorized into several types, including market risk and interest rate risk. Market risk refers to the possibility of losses due to fluctuations in the overall market, which can affect the value of the fund's underlying assets. Credit risk arises from the potential for defaults by issuers of bonds or other debt securities held by the fund. Interest rate risk stems from changes in interest rates, impacting the value of fixed income securities in the fund's portfolio. Investors must assess their risk tolerance, investment goals, and time horizon when selecting mutual funds, ensuring they choose funds that align with their risk preferences while aiming for potential returns that meet their financial objectives. 6. Mutual fund investment strategies. Mutual fund managers employ various investment strategies to achieve the fund's investment objectives and generate returns for investors. 3 common mutual fund investment strategies include growth investing, value investing, and index investing. Growth investing focuses on identifying companies poised for above-average growth rates in earnings and revenue. Fund managers seek out companies with strong growth potential and invest in their stocks, aiming to capture capital appreciation over the long term. In contrast, value investing involves selecting stocks trading at a discount to their intrinsic value. Fund managers look for undervalued companies with solid fundamentals, such as low price-to-earnings ratios or high dividend yields, intending to capitalize on market inefficiencies and generate superior returns over time. Index investing, also known as passive investing, replicates the performance of specific market indices like the S&P 500 or FTSE 100. Rather than actively selecting individual stocks, fund managers invest in a portfolio mirroring the index's composition, aiming to match its returns while minimizing expenses and turnover. 7. Choosing the right mutual fund. Selecting the right mutual fund involves considering several factors to ensure it aligns with your investment goals, risk tolerance, and time horizon. Start by defining your investment objectives, whether they involve growth, income, or capital preservation. Assess your risk tolerance or the degree of uncertainty you can withstand regarding investment losses, which can vary based on factors such as age, financial situation, and investment experience. Next, consider your time horizon or the length of time you plan to hold the investment, as this can influence the types of funds suitable for you. Research different mutual funds, evaluating factors such as past performance, investment style, fund manager expertise, and expense ratios. Diversification across asset classes and fund categories can help mitigate risk and optimize returns. Additionally, consider seeking advice from financial professionals or utilizing online resources to aid in the selection process. 8. Expense ratios and fees. Understanding the costs associated with mutual fund investing is crucial for investors to make informed decisions and maximize investment returns. One significant cost to consider is the expense ratio, which represents the percentage of a fund's assets allocated to cover operating expenses. These expenses include management fees, administrative costs, and other operational expenses. Generally, lower expense ratios are preferable as they can have a significant impact on long-term investment returns. Additionally, investors should be aware of sales loads, which are fees charged when buying or selling mutual fund shares. By understanding these costs and fees, investors can make informed decisions and minimize the impact of expenses on their investment returns. 9. Diversification in mutual funds. Mutual funds provide investors with valuable diversification benefits by offering exposure to a diversified portfolio of securities spanning different asset classes, industries, and geographic regions. This diversification strategy aims to mitigate risk by spreading investments across various securities, thereby reducing the impact of any single investment's performance on the overall portfolio. With mutual funds, investors gain access to a broad range of securities that may be challenging or costly to assemble individually. These funds diversify across stocks, bonds, and other asset classes, offering investors a balanced risk-return profile. By spreading investments across multiple securities and asset classes, mutual funds aim to minimize the impact of market volatility and potential downturns, while also potentially enhancing long-term investment returns. 10. Tax-efficient strategies. Investing in mutual funds entails various tax considerations that investors should be mindful of to optimize their investment strategies and maximize after-tax returns. One significant aspect is capital gains distributions, where mutual funds may distribute capital gains to shareholders resulting from the sale of securities within the fund's portfolio. These distributions are typically subject to taxation and categorized as either short-term or long-term capital gains depending on the holding period of the securities sold. To mitigate the tax impact of investing in mutual funds, investors can employ tax-efficient strategies. This includes opting for tax-efficient funds such as index funds or exchange-traded funds, ETF, which tend to have lower turnover and fewer capital gains distributions. Additionally, investors can utilize tax-deferred accounts like individual retirement accounts or employer-sponsored retirement plans to defer taxes on investment gains until withdrawal. 11. Summing up, as you embark on your journey into mutual fund investing, it's essential to recognize the significance of knowledge. Understanding the basics of mutual funds, including how they are structured, how their performance is evaluated, and the different types and investment strategies they employ, provides you with the foundation to make well-informed decisions that align with your financial objectives and risk tolerance. Mutual funds offer a diverse array of options, each with its unique characteristics and potential benefits. By familiarizing yourself with these aspects, you can select funds that best suit your investment goals and preferences. Whether you're seeking long-term growth, regular income, or capital preservation, there's likely a mutual fund strategy tailored to your needs. Diversification is a cornerstone principle in investing, and mutual funds excel in this regard. Time for the soft question. Would you consider investing in mutual funds and why? Please share your thoughts in the comment section below. This will help everyone learn and grow together. Subscribe with us and learn. If you find the information in this video valuable, please subscribe and share it with family and friends. Your support will help us create many more high-quality videos like this. Please support us. Please hit the like button and the notification bell to be notified. Click on these 2 videos shown here to explore even more. The contents of this video are for educational and informational purposes only. Thank you for watching.